Hello and welcome to. We are awaiting the return. We'll be joined by Dominic on this side, and I'll probably be crossing over to him on the on Behind the Markets, the radio section. So to all our Facebook, follow all our Facebook listeners. On both the Money FM page and also my personal page. And also for those who'll be joining us on YouTube, you finally are catching this live streaming on YouTube. For those of you who want to catch it now, thank you for joining us. And we will be catching on as many platforms as possible. So thank you very much once again for joining us. And it is the fourth day of the new year 2023. And today we'll be looking at a lot of things to do with markets, investment, and getting into your investment strategy. Because remember that Wednesdays we do midweek markets where we get down to investment strategy. That's the advisory stuff that we give you. Today we'll be traveling through a bit of news catch up. For the week, just some basic news that we'll be catching up on. Second thing we'll also be touching up upon is the Economist's list of 5 mega global trends that will affect the global economy and open up new markets, or things that will be affecting even international relations. We'll also then be touching on what markets are looking like, how they closed last year, and then going into this year. We did do a roundup, but we're obviously just going to touch on that one more time just to get some establishment of an idea, and then talk about investment strategy. You know, we have been talking about consistency, and we'll be talking about simplicity going forward. So thank you very much for everybody who is joining us today. Let's get into it as we await the joining of Dominic on the other side. Now, so let's start with obviously the Forex market. And I think we may have him in just now. Good morning, Dominic. Okay, it appears we still have a few technical issues with our brother
Morning.
Dominic, but for now,
Good morning.
good morning.
to
Can you
um, how about Tuesday?
Right, still having a bit of trouble. Right, so let's get down to it. First things first, we are on the 62nd day of the kwacha losing value against the US dollar. We are down 9% in the last 364 days. It has actually been about 8.5%, in the last 364 days. It has been quite a bit of a beating for the currency. For our currency in general, and therefore it is creating a little bit of that usual January probably inflation pressure that'll pick up. Now, remember, we closed last year with about 9.9% inflation. So we'll see if base effects will continue us on that 9.9%. It'll tell us whether we have monthly inflation that's going to be rather strong. What might help is the reduction of energy prices from the previous section, but we are already starting to get energy deficits starting to show their face throughout the year. So taking a look at the markets so far, we are, as you said, we are seeing a little bit of we are seeing the kwacha holding, as I said, holding at about 0.27% down on the day, 18.14, but it's down 5.7% on the month. That was a heavy loss just for the currency itself. A 5% loss of the currency on the month just because the farmer input support purchases is relatively even big for it as well. So 60%, 62 days of selling of the kwacha. When you're looking at the kwacha against the rand, on the other hand, the kwacha is down about 0.43%. Sorry, the rand the rand was down 0.43%, but it's also gained about 7.46%. So remember that our import destination is South Africa. So that might actually affect as well some of the consumer goods import prices that we should be experiencing as well. So take a very close look at what we're seeing on the markets here, and we'll see that, and you will see that there is a little bit of a struggle here in terms of what we are reading, in terms of our currency markets and how it's going to affect the rest of our economy. Now, taking a look at the bond markets, we did see bonds closing. Bonds did effectively close out the year somewhere to the point of about 940. In other words, up 14.16%. Now, that's decent for bonds towards the end of the year. And as you can see that we're still on an upward movement. But when it comes to bonds and dollars, we did see a little bit of the bond market return return to prominence in dollars, mainly because we did see interest rates start to come down and bond buying has been around. And hopefully we've got Dominic back now. If not, we'll just have to soldier on. And we're seeing interest rates dropping from 27% down to 23.7 down to 23.66. So we have seen a dip back downwards in bond yields, meaning that on the secondary market there has been purchasing. Good morning, Dominic. Hopefully we've got you back now. Okay, still weak, unfortunately. So midweek looks like we're going to be rolling. It looks like we'll probably be rolling solo. And when we get Dominic, we'll get Dominic. Right. So, yeah.
Hopefully as well.
I don't know if you can hear me now. Can you hear me? Right. I think we're just gonna have to soldier on for the purpose of those who are viewing. Right. So looking at the looking and also looking into the stock market. Obviously, it was a quiet first day. Lusaka Stock Exchange still closed about 21.8 as of last year. So we did see that was a good time. And obviously, if you factor in the potential dividends that were being paid, then you did see that the stock market did do pretty decently. But at the beginning of the year, we saw very little instead of trading activity that moved any prices. Just a few traded shares here and there, but nothing really to move prices on. We have zero movements across the board on the stock market. We are waiting specifically for the ZCCM royalty deal circular, which should be coming out on the 5th or the 6th. So we're waiting until the end of this week, either tomorrow or the day after. We should actually be waiting for a circular that gives us much more details now on the muchly anticipated deal, which either is going to make ZCCM a buy or it's going to turn it into one of the worst political stories that we've seen, because it appears that everyone has kind of made a decision without actually seeing a detailed breakdown or going through the things that we had gone through in terms of the interviews that we did with all the actual people themselves. So these have been the main market movers that we've seen from the main market plays in the economy. Now let's take a look at some of the major global portfolio positions, and starting with the mega commodities. When we take a look at mega commodities, we have seen that oil is closing at about $81.52. That's crude. That's Brent crude oil. Now that is speaking probably to a continued position of where the oil price will stay. Remember that there's a new tax regime, so we already had lower prices priced into last year before we even had the tax changes. Now we should have the impact of taxes coming into this month at the end. Remember that there's a new tax regime that has come in, which has scrapped off just the import duty itself. It hasn't scrapped off all of it, just the import customs duty itself when it comes to it. So when you look at the commodities board, you will probably see that the holding of oil around $81, $81.52 will probably give the oil market a much firmer position and probably give us an opportunity to hold oil. To hold oil a little bit still. So I think that's the main hope for us. Now, when you're looking into copper, you're seeing about the same price, 8,313 per metric ton, and for gold, 1,845. And with a stronger kwacha, our gold looks like it's going to be the strong asset of the first quarter. Now, similar with the Ukraine war last year, we saw the same thing. Gold was the strong asset of the first quarter. So it was actually doing relatively well during this period. But that was mainly because of geopolitical global uncertainty that was creating more people flocking towards gold while we were having weakening of our currency simultaneously. Those two things together created a situation where a lot of the money was heading towards a much better gold price. But for those of you, as I said, there is an option to hold gold tokens until our markets open up for us to be able to hold gold bricks that are gathered from inside our nation. So, taking a look at also other market closes for the period, we are seeing when it comes to the Africa 4, the main ones, with the Africa Global Index has done very weak. It's not done much growth today. While we're also seeing that the Rand is now back at 16.97. It's continued its strengthening path. with the Kenya shilling at 123. Now, this has been a really brutal year for the Kenya shilling. If you take a look at its performance over the last year, the Kenya shilling has lost 9% of value versus the Rand, which has lost 6.7%. That's why the Rand is looking a bit stronger than us today. And to those who are joining us, Happy New Year to you, Mr. Jebi's Piri. Thank you very much, and Happy New Year, and thank you for the wishes from the Money Team as well. Thank you for the wishes to us here at the Money Team. It is going to be a blessed 2023, and we're going to be your captains of the ship to ride you through it. Welcome, Dominic. Hopefully, this time we can keep you stuck in this time, and we're just going to keep riding out the ship until we can get you to hear us. Simultaneously, we're also seeing that the Egyptian pound has been one of the worst performing currencies. Worst, people. When I say worst, I mean worst. The Egyptian pound has gone up by 57%. The exchange rate of the Egyptian pound to the dollar has gone up by 57% in the year, creating an unsustainable situation in Egypt, while the Nigerian naira has also lost about 8% of its value in the year. Kind of puts a lot in perspective with the kwacha, which only lost about 8%. So if we're going to put all those three in perspective, with the Kenya shilling losing 9%, or the exchange rate going up by 9%, with Egypt going up by 58%, basically, that's actually been a struggle period for them. When you're looking at the stock markets as well, the South African stock market performed upwards of 2.1% yesterday. It appears any signs of Ramaphosa seem to be coming back into the fold, especially now that he's getting his energy and his mojo back. The Kenyan exchange rate, the Kenyan stock market also up about 0.63%. The Egyptian stock exchange up 0.72% yesterday, while the Nigerian stock exchange is up about 0.67%. So you had a positively green day across all stock markets yesterday. But you have seen that throughout the year, if we're looking at last year's performance, the main performing stock exchange, the Egyptian stock exchange, even though Egypt had a horrible run, the Egyptian stock exchange was up 25.12%, with the Nigerian stock exchange up 18.67%, 18.67%. But the Kenyan stock exchange down 12.51%, and the South African stock exchange throughout last year basically did not move. It went down and recovered back up and closed the year exactly where it started. And if you're looking at bond markets, yields in terms of interest rates for the bond market, you are seeing that South African 10-year yields are sitting at about 10.45%. They haven't moved basically, while Nigerian yields also are sitting at about 13.442%. They haven't moved, while Kenya and Egypt are experiencing yield upwards movements. So there is a mix happening in the major four African economies, giving us a signal that there is a positive sentiment in terms of the stock markets of Africa from yesterday. They did seem to be a risk-on sentiment of cash flowing into our markets, but whether it's reflected into our stock exchange, that's a little bit of a difference. We'll be waiting for results and any market moving events. And now when you're looking at emerging markets, it's a similar story. The emerging markets data is showing that a lot of the currencies were losing value yesterday in emerging markets, though the Morgan Stanley Emerging Markets Index did show positive movements in emerging markets, but we did see that currencies were moving weak. Those stock markets also were all in the negative. So you did see a selling off. So it's not exactly like it was a global trend that was moving money into developing nations. It's just that African stock exchanges did do well yesterday as a starting bounce, because the rest of the emerging markets took a walloping yesterday to get started in the year, even though there's been positive sentiment, especially because the expectations are interest rates are supposed to start coming down on the major economies. And finally, in terms of the global markets, the main readers or the main markets from yesterday, we did see that interest rates on U.S. bonds are down to 3.72%. They haven't knocked all the way down to about 3.6 or below 3%. So we're still seeing a lot of bullishness on sending money back to the U.S. itself. The S&P 500 was still down yesterday. So you did see positive trade in bonds, but still a weaker S&P 500. 10-year Chinese bonds were down as well. Interest rates were down, so you can see that there's also still positivity in there. it's the Japanese bonds where everyone has still got an eye, because remember that 10-year cap moved up to 0.5%. That's the first time the central bank in Japan has done that, meaning that there is a little bit of selling off that pushed interest rates and pushed yields up 2.7% of those yield factors were being moved up, while German interest rates also were in selling. German bonds are in selling position, and the UK bonds were also in selling position. While you're seeing the Shanghai Stock Exchange is performing positively this morning, with the Japanese Stock Exchange performing negatively. So they're selling off in Japan. Now, that might be a signal of what we call risk on trading. Remember that everyone who flies, whenever money flies into Japan, it's for safety purposes. But now it's like people are fleeing Japan. And now we're not sure whether it's safety purposes or whether it's just the negative perception right now of Japan due to the higher yield cap that they put on their 10-year. So those are the global market reads in terms of where we expect to go. But now let's take a look at our economic calendar before we kind of wind up this data digging session, go into major news items and the 5 mega trends, and before we wind up in investment strategy for today. So any of you who are watching, please cue in and state in any questions you have on investment strategy or anything that is happening, but any questions that you have on investment strategy, I would love to be able to peek out and answer some of them to help you get ready for the beginning of the year. But now let's get into data that happened yesterday and data that is good that came in today. Yesterday, obviously, there's still some countries that were still celebrating New Year's Day all the way into Botswana. They were having the second day of New Year's Day yesterday. And today we're seeing CPI data coming out from Turkey, where inflation in Turkey is finally coming down to a whopping 64.27% from 84.39%. Lovely to see that they're finally having inflation come down. Monthly inflation came down from 2.8% to 1.18%. And you are seeing PPI's data, in other words, producer price indices. Supply chain inflation has come down from 136% down to 97.72%. So yes, to hear such walloping numbers, but that is an improvement in the Turkish situation. Spanish unemployment has dropped by 43, so we are seeing positive in the Spanish numbers. German CPIs, now this is very important because Germany has had very elevated inflation for some time, and we're seeing German inflation is starting to come down to 8.6. These are caps on Russian oil in terms of the prices of Russian oil that are starting to have an effect, with HICPs also coming down to 11%, while you're seeing also the Egyptian reserve numbers have gone up, ironically, even in these tough times where Egypt's currency is losing value. And you're seeing the manufacturing PMIs coming out of Japan are getting worse and worse. So manufacturing in Japan seems to be losing its steam. Now, taking a look at the data, we are expecting to close out the day with Indian PMIs are still up 58.5. We're going to have a wonderful story on India later today, which you're all going to really want to pay attention to. And also just looking at what that is going to mean for us as a country. Europe's, you're also looking at European import prices or German import prices as data we're expecting today. Italian PMIs are expected to come out today. Mortgage data coming out of the UK to see how well that affects copper, while simultaneously we'll be looking at mortgage data from America, vehicle sales from America, job data, and the ISM data that'll show us their PMIs coming out of America. So what are we seeing? We're seeing inflation still cooling down globally around the world. We're seeing interest rates still coming down as well. So the monetary side is still showing rather positively, especially if we get our debt renegotiated in this first quarter like we're planning to. There's a story that we're waiting for from that. And also simultaneously, we're also seeing that PMIs are still not fully recovered around the world. So industrially, we're not too strong. Good growth data is also still tepid. So we're somewhere in slow growth, but lowering inflation. And that's the quadrant where people are looking for cash flow and cash safe investments. That's what you're looking for around the world, and that's what everyone is gravitating towards. We're going to take a break for now as we go into our break. Remember that Behind the Markets is brought to you by Zanaco, our bank and our sponsor in this show. And we'll be taking a break as we take a word from our sponsors. We will return on the other side with two major stories from Zambia. 5 trends that are going to be dominating 2023 according to The Economist magazine. And also we'll be looking at investment strategy for 2023, and I'll be talking about simplifying your investments. Please stick around as we talk about it, but give us your questions and catch you on the other side of this break. And we're back live. And from the break, thank you very much joining us back on Behind the Markets. And a happy new year to all of you in the first midweek market session of Behind the Markets, where we're going to try and take you through investment strategy and investment analytics for this period. So remember that Behind the Markets is powered by Zanaco, your bank. Right. So let's jump into some of the major stories for yesterday. Two major stories, obviously, is obviously debt relief is the first one. Trying to figure out how to strike a deal on debt. Now, I think our president had actually been in Washington recently, where he did have an interview with Bloomberg, where he had stated that, look, we are trying to make it, and he did state that, look, he has spoken with U.S. leaders, including U.S. Treasury Secretary Janet Yellen, about any holdups surrounding the nation's debt processing. And he was basically speaking to Bloomberg about how they're trying by all means to get this to a head. Now, there are concerns coming in from the World Bank, and there are concerns coming in from the IMF about how slow the process is becoming. But remember that it's not easy for Zambia because we are an equal representation of Western and Eastern debt interests in one pile. So geopolitics has the ability to play out in our session. So we have to be very careful right now. Geopolitics has the ability to play out into our debt negotiations. It does seem that both are trying to race to look good in this situation because there is a race for Africa. And obviously, President Biden throwing that Africa summit basically was sending a signal to China to also say, look, we're in the game now. So it's not just you anymore trampling through Africa, getting your way and getting everything you want. We're also going to be there trying to now figure out how to make a play for Africa, because these guys are the ones who are going to have all the resources that are needed for this EV battle. Remember, there's an EV battle happening between the West and the East. Whoever can control electric vehicles is the person that's going to control the future. And we're going to be talking about which nations are going to be controlling the future in general. But therefore, Zambia's debt negotiations does actually have a geopolitical component to it. But whether we can reach an end by the end of this quarter will be another story. Now, remember, one of the biggest things about Zambia signing, getting its IMF deal was to get China to sign to the G20 Common Framework. Remember, we were the first nation to get China onto the G20 Common Framework. And you'll notice that why the IMF and the World Bank are putting so much energy behind Zambia is that they're trying to prove the G20 Common Framework works to help manage Chinese debt, but also at the simultaneous time, there is a battle over trying to manage who can manage through an indebted situation as well, who can manage indebtedness in this way. China has got a huge portfolio of debt sitting around in Africa, and a lot of it is defaulting. A lot of their Belt and Road loads are defaulting right now, while they're dealing with domestic debt problems in their property sector and also domestic debt problems in their local municipal bond sector as well. So there's huge defaults happening in the local government bonds in China. There's huge defaults happening in their property sector, and there's huge defaults happening in their offshore lending. So these three portfolios are really creating a credit risk for China right now, which they're trying to manage and they're trying to contain with the internal monetary policy and also offloading of their reserves. So this is not an easy one for them. It's not an easy to write off things as well, but it's actually not easy for them to just let go, because it will let go of a lot of the power positions and buildings that they've been happening in Africa. It's not just about Zambia, people. Zambia is a test case for what is happening across Africa. So we are just the canary in the coal mine, we're not some special story only. Everyone is looking to us because they're going to be expecting the same treatment that comes out. And that is why China is under such immense pressure when trying to negotiate this. Then you've also got your private creditors who people are trying to put pressure on, and they are also in the middle of a losing session in their bond markets, and they're not willing to let go of things as easily. Now, some of them did swap out their euro bonds in order to buy local government bonds in that September auction of that August auction of the September auction of 2022. Now, that was the one time where you saw a lot of 10-year bonds being bought by international investors because they were seeing haircut conversations happening in the euro bond sector. So therefore, they just sold out their positions, took a loss, and came in for really high interest bonds there. That trade out did happen, but some of the other sour grapes are holding on to their bonds. So whether our president will be able to reach that conclusion by the end will be another story. Another part of the news cycle is obviously that given there was a consortium of American and Chinese interests that came together to help finance the Batoka Gorge, which is supposed to be a 2.4 gigawatt a 2.4 gigawatt power station, which is supposed to alleviate all of our energy stress. We've been trying to build this gorge out since 2010. It appears that recently Zambia and Zimbabwe have come together to go and seek financing from the African Development Bank to try and help see if we can now offload some of Southern Africa's power issues. So by actually bringing that now, that's a $4 billion project. So remember that Zambia needs about $15 billion of energy financing, electricity financing, which is in order to be able to reach its deficits and also to push itself towards the ability to produce 3 million tons of copper. There's electricity needed for that. We're going to need about 3 times the electricity that we have to be able to do that. Now, the Batoka Gorge will be able to reach that. Now, that's only a third of the energy investment we need as a country. That's just 1/3 of the energy investment that we need. So I think one of the biggest conversations that we should be having as a country, especially when discussing green bonds, because we're trying to make green bonds tax-free in terms of yield, in terms of the coupons, no withholding tax on those coupons, and in terms of trying to make them more attractive. We should be our main conversation now as a country is how can we use our green bonds and our green bond infrastructure to attack the energy crisis. This is conversations we're having even in the securities industry now to say, look, this country has got a relevant issue that we need $14 billion, at least in the next decade, of energy investment and consistently coming in. And we need to start packaging these things as green bonds because especially the fact that we're mostly going to be doing hydro projects. And hydro projects do sound are green energy projects because it is renewable energy. So if we can get as much of our hydro energy projects being packaged as green bonds finance, we then can attract the different types of capital that can be cheaper, and we can start to finance these things a bit more efficiently. But it will take, and this is just the honest point, people. Green bonds, the $14 billion worth of green bonds cannot be financed domestically. $14 billion worth of green bonds to finance our energy grid or our energy enhancements over the next decade cannot be done totally domestically. We already have a domestic issue. Just our total bond market, by the way, just to put this out there, our current bond market, which sits at about 150 billion, our government bond market, which is about 150 billion to 160 billion, is less than $10 billion. Okay, so we're going to need more than what's sitting in our government bond market. So, meaning it's going to have to be our pension funds, it's going to have to be a combination of our pension funds, our people, our everything combined together again to now flood out that green bonds market. Now, do we have the depth of capital to then reorganize another 150 billion kwacha domestically over the next decade? It's not impossible, but it is a tall order to only do domestically. So we'll probably find that as we're trying to finance some of these projects without also taking a mega hit on our finances as a country, we're going to need to make sure that even the international community simultaneously, alongside our pensions, our local savers, and our banks, are all channeling as much of money as we can into this. All these green outcomes funds that have been passed through banks like Zanaco, who have gotten some of these. It's time to then take these hundreds of millions of dollars that have been punched through some of these and then start translating it into green bonds for some of these projects. Obviously, you don't want them overly concentrated. Things like Matoka will be one of the biggest ones, but you have to do that thing in sections and tranches. You can't just do it all the way as one main thing. But you can see that there is an evident amount of financing that will come to play. Now, the problem is due to the slowdown globally, even green bond issuance and even green bond uptake has slowed down globally. Now, it hasn't diminished the way the bond market has, but it has started to slow down because it has been doubling regularly throughout each year. It's just that last year it slowed down a little bit from doubling. So global green bond issuance did slow down a bit. But those are the two main stories. Calculating our debt and seeing, one, we're getting financing from Batoka Go to try and from African Development Bank to see if we can do it a little bit self-sufficiently. But the main conversation should be the electricity deficit of this country must be dealt with the green bond instrument. And we should be now having this continuous conversation until we actualize the flotation of green bonds into our country to make sure that many people can also participate. Now, I've talked about green bonds versus investing in government bonds. You don't want to offset that because your government bonds are very low risk instruments that you can invest in, and they give you strong yields for now. Green bonds will be able to, especially if they're not just government oriented, but they are actually electricity projects. Green bonds should then be able to give you access to corporate bonds a little bit higher with zero tax implications, but not obviously as high as the lending market itself. So that's a little bit of the information that's coming out. So let's take a look at a few questions that have come in. I don't know if we can now get our brother Dominic back in. Dominic, I don't know if you're in with us now before we move into a few questions and we move into the 5 trends according to the economists. Okay.
Yeah, pretty
So I think
much in, but can you hear me?
yeah, no, we can hear you. We can't see you. Maybe that's for the better, Dominic. Maybe that's for the better.
Yeah, absolutely. Yeah,
That's for the maybe it's for the
yeah,
better.
uh,
Well,
yeah, pretty much sad. But maybe we could get to the question that JB Spear is perhaps asking this morning.
yeah,
Um, JB Spirit, yeah. With a shift
he's
on interest
asking.
rates
Yeah,
for Bank of Zambia, U.S. bonds getting higher and stocks shifting from last year's position on more rate hikes, what ratio for example, 60 or slash 40 would be the best for a personal portfolio with a weakening quarter in 2023. Perhaps you can comment on
Okay.
that.
Okay, yeah, no, that's a very good question, especially with the weakening kwacha. So I'm going to take into consideration the biggest threat that they're facing, that you're facing here in your portfolio, especially if you're a Zambian abroad, because that's the main concern. If you're a Zambian abroad, what is my play here? Because I'm losing 5,005%
Mm.
on my I'm losing 5% on my currency. So the currency drain, we're not sure how long this is going to last because this one has been really strong. It was vicious. Last year, you lost on the last month of last year, you lost 5% on the value of all your Zambia portfolios because of the weakening of the currency. And it's not anything to do just even with the BOZ position. Now, there's no movement that's going to be happening in terms of higher interest rates. I'm not sure. They have tried the FX containment, but I think they're going to try and assess to see if this is just seasonal. And if it's not, if it's structural, then we'll see by the 14th whether they're going to start switching to actually now utilizing full-blooded interest rates in terms of curbing inflation, because there is inflation risk coming. But remember, the problem is that we're not actually getting readings of higher inflation as a country. We're still within the 10% range, so they're not really tempted to start going after inflation using the interest rates yet. And they have been actually contracting out monetary policy. These guys are not dishing out money anymore. So they actually have been pulling out. If you look at money, if you look at the banks themselves and their balances at the central bank, their balances at the central bank are down by 12% from the previous year. From in terms of September 2022 reads versus September 2023, they're down 12%. So these banks have literally just wiped out their positions at the central bank, and they're starting to do that because they had huge positions. Now, obviously, interest rates in America are starting to lower now, mainly because of the fact that the Federal Reserve, yes, is raising rates, but the expectation is that it's now slowing down in raising rates. Remember, it moved from 75 basis points to 50 basis points, while some of the Western some of the Western central banks are now slowing down as well. So we're going to see a slowing down of rate hikes all the way up until the third quarter. That's when you'll probably see a neutral position and a turn. There's the expectation that they're going to go into a mild recession as a country somewhere in the middle of the year to the third quarter. So, what is the position of a portfolio that a person should be holding? So, let's take a look at the environmental factors. Remember what I always say about your investment strategy. Your investments are like the clothes you wear, and you wear clothes according to two conditions. Okay, you wear clothes according to how hot it is, hot or cold, and how dry or wet it is. In other words, is it raining? Is it hot? These are the two questions that you answer to decide what clothes you put on. Simultaneously, we do the same thing with stocks. We do the same thing with portfolios. So when we're looking at what you should be doing in terms of your asset portfolio, the first thing you should be looking for is you're not in a very strong inflationary position. There is inflation risk, but you're not in a very strong inflationary position. But due to the inflation risk, I'm still thinking that portfolios of the regular person should be sitting not 60%, 40%. That's a lovely one for the US, but for Zambia, you should be sitting somewhere 70 in the bond spectrum. Okay, you should at least have 70% of yours sitting in the bond spectrum. That's if you're moderate. If you're moderate and you're average, you should be sitting somewhere about 70% in the bond spectrum, just for safety's sake. In terms of your active portfolio. So remember, your active portfolio is at least 85% of your total portfolio, because 15% of your portfolio is going to be held in what is called wealth insurance. So your wealth insurance right now should be majority gold. Gold will give you a lot of the dollar upside with geopolitical risk upside as well. So you want to hold that gold for that position too. Now, when we're looking at the active parts of your portfolio, I would say about 2/3 to 70% of your portfolio should be held in bonds, and then the remaining 30% or so should be held in stocks. Now, even the kind of stocks you're picking, you really want to be defensive right now. Growth is not the play yet. The reason I'm saying is you have a little bit of an energy problem kicking in. You don't want to be caught on the wrong side of this, mainly because margins are going to start getting razor thin, especially in the first half of the year. Given the energy problems we're facing. So you want to really go for the stable ones that are established and know that they're going to make that cash flow payment. So who are your dividend stocks? You really want to rotate that 30% as much into dividend stocks because you're looking for fair value cash flow this time. Just in this period, at least, you're looking for the things that give you the opportunity to be fair valued. So you're not looking for rapid capital appreciation. You're looking for cash flow. So you're looking for bonds that can give you reliable cash flow. You're looking for stocks that can give you reliable cash flow. And the things that can give you reliable cash flow, 2, 3, obviously all your bonds can give you reliable cash flow, but because of the inflation risk, 2, 3, 5 years still, because of that inflation risk that you're taking, while simultaneously also look at having a stock portfolio of about 30%, but rotating more into fair value cash flow generating stocks. Who are your dividend stocks that are priced fairly? In other words, they've got a PE ratio somewhere of about 5 to 7, and they're still paying out and they've still been paying out a healthy dividend and are likely to pay out a healthy dividend. There's some stocks you can look for in there. That's the portfolio I'd be looking at. But keep your portfolio 70% sitting in the short end of the bond market, especially just to ride out this first half of some of your issues that will be coming up. So that's that. Thank you very much, Jebbies, for that question. And for any other questions, thank you very much, and a happy new year to as many of you who are joining us in. Now, I'm going to give you trends, 5 trends that actually come from that are coming out of The Economist in terms of global. These are things you want to pay attention to. 2 of them, sorry, are market moving trends. You want to pay attention. So the non-market moving trends, and these are business opportunities or industry investments that are happening around the world, is number one, the rise of psychedelic drugs. Now, as a Christian nation, that's something that we have to try and navigate very carefully. But we are starting to see countries like America approving therapeutics by using psychedelic drugs like magic mushrooms and cannabis in some instances to treat psychological disorders or sicknesses such as PTSD, alcohol abuse. They're actually utilizing psychedelic drugs for these, and they're getting approval. So as we're trying to now step around our medicinal cannabis industry and what uses it shall have, we may start to look at trends that are starting to occur in the psychedelic drug industry, and to see whether, and this is just even morally as a country, we have to toe this question very carefully, whether we are going to participate in those exports or not. Okay, so this is a question. Now, I've always said we must first go with industrial hemp because that's got no drug component in it. It'll help us replace textile imports. It'll help us replace textile. It'll help us replace textile imports, fertilizer imports, and part of the fuel import by creating ethanol from the stalks to be able to produce fuel. So I always say that first and foremost we should be dealing with hemp. In about 2-3 years, then we can prep ourselves to see if we can start dealing with medicinal cannabis. Because once we can get into the proper cultivation and then make sure these things are not mixing up too easily, but we should start with hemp first. But psychedelic drugs are starting to show some signs that probably in the next 3 to 5 years, we should be making considerations whether we should have a policy in place to make sure that we're exporting medicinal, not recreational, medicinal cannabis towards those parts. Towards those markets. The other part also is now there is a new trend happening for those of you who are in the clothing industry. There's a new trend happening called repairing. A lot of the major brands in the world, and I'm talking about the high-end brands like Louis Vuitton and these ones, are now starting to create a repair market for clothing where people can repurpose and repair clothing and resell them, as opposed to always selling fresh clothing that ends up in the incinerator and becomes waste, because every time they're releasing new brands, or new styles and new falls and new lines and so forth. So for those of you in the fashion industry, that's a trend you want to pay attention to because it's one of the biggest global ones that The Economist has cited. And finally, colonial antiques. Many countries, especially with the coronation of King Charles, there are questions about the crown that the Queen Consort is going to be wearing, about returning that jewel back to India. And many other countries are requesting, especially with Germany sending back some antiques back to Nigeria. So it appears that there is some sort of racial reparations that is starting to happen, mainly based on some of the things that we have seen in the global economy. So we want to just in the global environment, the rise of wokeness, for example, has now started to spread to the point where it appears we might be getting some of our art back, some of the things back. So there are questions now about what the major Western countries are to do now about the history of colonization that has been plagued upon Africa. But two major trends that are market moving. Number one, India is going to become the biggest country in the world by population this year. Okay, so bear in mind, China is about to get dethroned for the first time in centuries. And we're talking about 5 centuries. China is about to get dethroned for the first time as the biggest population in the world, thanks to India. And the difference is that India, unlike China, does not have an aging population. They have a very young population. But unfortunately, they've also got a hugely informal population. So they're trying to balance things out. How do they get this growing young population who do not have formal sector salaries and stable incomes to become that number one economy, just like China has become? So that is the biggest battle that they're going through. But our biggest trade zone in the world, the biggest trade position, trade partner, the center of the global economy may start to shift from China towards India, especially now with the population swing. So we have to start looking at our trade relations and our business relations with India. Majority of our trade happens between China, especially imports, happen between China and South Africa. But we do have a third import source that comes in from India. So we're gonna have to look at how we're doing business with India, especially even exporting towards India. And finally, the biggest market moving event, or biggest market moving trend that we all need to watch out for is Japan. Japan is the biggest risk to the global economy because if they do not handle their bond market well enough, they can turn what is supposed to be a mild global recession into a horrible global meltdown. You see, Japan right now is in a situation where they have a weakening currency because every other central bank has been raising their interest rates, while Japan has not been raising its interest rate because inflation did not pick up. But unfortunately, the Japan yen has actually gotten so weak that imports have now started importing inflation into Japan, and therefore that's why you heard the Japanese BOJ raise its cap on the 10-year bond from 0.25% to 0.5%. Now, what that has done is that's created a situation where there has been selling off of assets. Now, remember, Japan is the biggest holder of offshore credit. Okay, they hold bonds of almost every country. Japan is one of the biggest investors around the world. Because of their loose monetary policy, a lot of money has been placed in. So when they start tightening, a lot of the global economy starts crunching and shaking. So if Japan goes into a super sell-off and starts going into a rate hiking cycle, you will see stock markets around the world probably start folding very quickly, because then you'll start to see the Japanese component of their markets slowly getting drawn out. And that will start to affect a lot of the returns on investment and the risk on sentiment, and therefore even affects people coming into Zambia to make investments here and probably pull off our market. Now, our stock market is not at risk because the majority of offshore investors have exited our stock market long since 2019. It's our bond market where maybe there's a bit of a risk. And when that happens, it means these people start selling off their bonds faster than they've already been selling them off. And if they start doing that, that's a currency hit for us. And once they start doing that, that currency then turns into inflation for us. So what will start in Japan as a market sell-off will end in Zambia as super strong currency-driven inflation. So that's what we're trying to watch out for. That's a big risk that you might be able to get to us. So we're just watching out to see how strong, how much the Japanese economy or the Japanese financial markets will be selling off. That's been your midweek markets roundup, giving you your investment strategy. My number one point for you today for investment strategy is simplify, simplify, simplify. You need a simple asset and a simple strategy to ensure that you are able to build the momentum. There are 3 bond auctions happening in the first quarter of this year. There's a bond auction every month. There are 3 bond auctions happening in the first quarter. And with that, I'm just with that my final word. There are 3 bond auctions happening in the first quarter. You want to make sure that if you want to build momentum this year, you want to participate in every single one. You've got the 52-week money challenge. Okay, so for the first 12 of them, you want to make sure you participate in each of them. This week, remember, people, we're saving 10 kwacha in the 52-week money challenge. At the end of this month, on the 20th, we're participating in the auctions. Every Wednesday, we are going to want to keep up with the 52-week money challenge and getting prepped for the next auction. Thank you very much to everyone who has joined us. Thank you very much to the team. And to those who've been on radio with us, thank you very much. Have a wonderful, have a blessed day. Dominic will catch up with you at a time when we're not at such interference. And to everyone, have a wonderful day and a happy new year to everyone. Welcome to 2023. And yes, thank you for everyone who's commented.